Welcome to the SmartKeys podcast.
It is the ultimate reality check.
Today, we are going to tackle a subject that probably keeps more founders, managers, and aspiring business leaders awake at night than anything else.
You hear that phrase thrown around constantly in business schools and boardrooms? Revenue is vanity, profit is sanity, but cash is king.
We are moving beyond the vanity of profit and diving straight into the sanity of cash flow.
It sounds like a cliche, but honestly, in the current business landscape where things move so fast, it has never been more true.
Absolutely. And to guide us through this, we are doing a deep dive today into a really comprehensive guide titled Cash Flow Management Strategies for Sustainable Scaling by Felix Römer.
That's the core problem. I see this all the time.
Now, the mission here is pretty specific. We want to take a stack of what could be considered, dry financial best practices and turn them into a strategic roadmap.
A lot of businesses grow their revenue, they see the graph going up and to the right, and they high-five each other.
Because let's be honest, you can have a groundbreaking product, you can have amazing sales graphs on paper, but if the bank account hits 0 on payroll day, the game is essentially over.
But then they stall, or completely fail, because they run out of runway. They simply don't have the liquid cash to fuel the growth they're experiencing.
I love that term, runway. It creates such a visceral image of a plane trying to take off before it hits the trees.
It does.
But let's unpack why this is specifically relevant right now. Why isn't profit enough? If I'm profitable, shouldn't I be safe?
Not necessarily. In a modern landscape that requires agility, profit is a theory, but cash is a fact.
A fact.
You cannot pay your employees with accounts receivable. You need to seize opportunities to hire talent or buy inventory instantly. If you don't have a clear runway, you are grounded. You simply cannot operate.
So let's get into the mechanics of this. The source material starts with the absolute fundamentals. It talks about knowing your runway by understanding the 3 buckets of the cash flow statement. Now, I have to admit, for a long time, I just looked at the bottom line number in my banking app. If it was green, I was happy. If it was red, I panicked.
And that's where so many people go wrong.
But Römer argues it's not just one big bucket, is it?
No, and treating it like one big bucket is actually dangerous. That is where a lot of people get into trouble. Römer breaks this down beautifully into 3 distinct sections.
Okay.
First, and arguably the most critical for the long-term health of the business, you have operating activities.
Okay, operating activities. This is the engine room.
Exactly. This is your day-to-day. It's the cash coming in from actual sales versus the cash going out for wages, suppliers, and rent.
Right.
And here's the key insight, the litmus test for your business model. Positive operating results mean your business model actually funds itself. It works.
So if this number is negative, but my overall bank balance is going up, that's a trap.
It is a massive trap. If operating activities are negative, it flags a fundamental inefficiency. It means you're losing money just by opening the doors every morning.
Oh, wow.
You might be covering that up with loans or investor money, but the core engine is broken.
Ouch. That is a crucial distinction. Okay, so that's bucket 1. What's bucket 2?
Bucket 2 is investing activities. This is where you place your long-term bets, buying new equipment, purchasing property, maybe acquiring a smaller competitor.
So this number is usually negative on this statement.
Usually, yes.
Which feels scary, right? Seeing a negative number.
It can be, but in this bucket, a negative number isn't necessarily bad. It means you are spending cash now to build capacity for later.
I see.
You are building a bigger factory to sell more widgets next year. But you have to balance it against bucket 1. You can't invest aggressively if your engine room, your operating activities, isn't generating the fuel.
Right. You can't build a new wing on the house if you can't pay the mortgage.
Exactly.
And finally, there's the 3rd bucket, financing activities.
This tracks the flow of money between the company and its capital providers, lenders, or investors. Are you taking out a loan? That's cash in. Are you paying dividends to shareholders? That's cash out.
So when we look at the liquidity runway, we have to look at the interplay of all 3.
We do, yeah.
The article makes a big distinction between positive and negative cash flow here, using that runway metaphor.
It does. Think of positive cash flow as oxygen. When you have it, you don't even notice it. You just breathe and do your work.
Right.
It gives you breathing room to hire that new developer or stock up on inventory without panic. Negative cash flow, on the other hand, sucks the oxygen out of the room. It shortens the runway every single day.
And when the runway gets short, psychology changes, doesn't it? You stop making smart decisions.
Exactly. Your IQ effectively drops. You enter corrective action mode. You start deferring non-critical purchases, which might hurt you long term.
You get desperate.
You start chasing clients awkwardly for money, or you delay paying your own vendors, which damages those relationships. You are reacting, not strategizing.
The source mentions a strategic takeaway right at the start here, setting a break-even target before chasing profit. Why is that the first step?
Because it anchors your scaling strategy in reality, not just optimism.
Okay.
If you know exactly what your break-even number is, the bare minimum to keep the lights on, you can make smarter decisions about everything else. It reduces surprise costs. It's like knowing exactly how many miles you can drive before the car stops.
That makes sense. Now, let's move to section 2 of our deep dive. We've covered the theory, but I want to talk about the rituals.
Rhythms of review.
Right. Now, be honest with me. Most small business owners I know look at their books once a year when tax season hits. Maybe once a month if they're diligent. Is that enough?
Not even close. If you're looking at it once a month, you're looking at a history book.
Right. What already happened?
You are reading a report on what happened 30 days ago. You can't change the past. The source outlines specific rhythms that are much more aggressive. You need a weekly review.
Weekly? That sounds like a lot of meetings.
It doesn't have to be a long meeting. It's a pulse check. You are tracking inflows coming in this week and imminent payments going out.
Ah, okay.
This allows you to act fast. If you see a gap on Tuesday, you can fix it by Friday. If you wait until the end of the month, the damage is already done.
There's a great line in the text. Treat the report as data you act on, not just a file you file.
Precisely. Then you have the monthly rhythm. This is deeper. This is where you clean the data, validate your assumptions, and actually close the books to ensure accuracy.
Okay.
And then quarterly, you do a deep dive to test seasonality and customer trends. But the real game changer here, and this is something I think every listener needs to implement, regardless of their business size, is the rolling 13-week forecast.
I highlighted that too, the rolling 13-week forecast. But why 13 weeks? That seems like such a specific, arbitrary number. Why not 10? Why not 6 months?
It's not arbitrary at all.
Yeah.
13 weeks is exactly one fiscal quarter plus 1 week of visibility into the next.
I see.
It is the sweet spot. It is long enough to see trouble coming, like a slow sales month or a big tax bill, but short enough to be accurate.
So a year out is just fantasy.
If you try to forecast cash flow a year out, you're just guessing. 13 weeks is actionable radar.
Okay, so how does this actually work in practice? Am I just putting in what I hope will happen?
No, hope is not a strategy. The methodology is to blend your past performance with your current sales pipeline. But here's the pro tip from the source. You don't just run one forecast.
Okay.
You run 3 scenarios: best, base, and worst.
Scenario planning. This sounds smart, but I have to play devil's advocate here. Who has the time to run 3 different complex financial models every week?
Right.
Most founders are barely keeping one spreadsheet alive.
It does sound like a lot of heavy lifting, I agree. But think of the worst-case scenario as your insurance policy. You define it once. What happens if sales drop 20%? What happens if our biggest client pays 30 days late? The reason this matters is that it allows you to set triggers for action.
Trigger.
Yes. You decide in advance when you are calm and rational. You say, if we hit the numbers in the base scenario, we proceed with hiring that sales director.
Okay.
But if the numbers start trending toward the worst scenario, we automatically trigger a hiring freeze and delay all non-critical spend.
Oh, I see. That is so smart. It removes the emotion from the decision. You aren't panicking in the moment and firing people randomly.
No.
You're just executing the plan you already made when you were calm.
Exactly. It converts volatility into a process.
Yeah.
And to your point about who has the time, the source mentions that you shouldn't be doing this manually in a spreadsheet if you can avoid it.
Right.
There's a big emphasis on using technology that syncs with your ERP enterprise resource planning system.
Right, getting away from manual entry errors. Fat fingering a 0 can ruin your whole day.
And it's about speed. Modern tools use AI to refresh these models in near real time. So your forecast isn't based on data from 2 weeks ago. It's based on what happened 10 minutes ago.
So we have our fundamentals, the 3 buckets. We have our rituals, the 13-week forecast. Now let's talk about the actual mechanics of moving money. Section 3 covers optimizing the flow inflows and outflows, or as I like to call it, how do we get the money in our pockets faster?
That is the million-dollar question. Accelerating inflows, or accounts receivable, AR, is about removing friction and ambiguity.
Friction.
The source is very clear. Speed comes from clarity. You need to tie invoices to specific delivery milestones. Don't wait until the end of a massive 6-month project to bill. Bill in chunks.
And automate those reminders, right? Nobody likes being the bad guy, sending the, hey, you owe us money email. It feels awkward.
Let the software be the bad guy. It's impersonal and consistent. But here's a specific tactic that I found fascinating, and it's a bit controversial. The discount strategy. The text suggests offering a modest early payment discount, like 2% or 3% if the client pays within 10 days.
See, that's where I get stuck, 3%. Margins are already tight for a lot of businesses. That sounds like a lot of money to just give away.
It can be. You have to be careful. The analysis here is critical. You only do this when the math makes sense to pull liquidity forward.
So what's the math?
Think about it this way. If you are cash poor and you have to borrow money on a line of credit, that might cost you 8% or 10% interest.
Yeah.
In that case, giving the customer a 2% discount to get the cash now is actually cheaper than the loan.
That's a great perspective. You're essentially buying your own money back sooner. What about the friction regarding how they pay?
Oh, this is huge. Make it easy to pay you. If a customer has to print a check, find an envelope, find a stamp, and walk to a mailbox, you are adding days, maybe weeks, to your cycle.
Right.
Provide ACH, credit card options, wire transfers. Let them pay in minutes from their phone.
Okay, that's money coming in. Now let's flip the coin. Outflows. Accounts payable. The goal here is keeping money in our bank account as long as possible without making our suppliers hate us.
How do we walk that line?
It's a delicate balance. You don't want to be the deadbeat client. The expert advice here is scheduling. Align your payment due dates with your receipt of funds. So if you get paid on the 15th...
Exactly. If you know your biggest clients always pay on the 15th of the month, try to negotiate your biggest bills to be due on the 17th.
I like that. Don't drain the tank before the refill truck arrives.
Exactly. And don't be afraid of vendor negotiation. Ask for extended terms. If you are a reliable customer, many suppliers will give you net 45 or net 60 days.
Which is basically a free loan.
It is essentially an interest-free loan from your supplier.
Yeah.
But conversely, remember that discount strategy we just talked about?
Yeah.
It works both ways. If a vendor offers you a 2% discount for paying early, and you have the cash sitting in the bank, take it. Again, do the math. A guaranteed 2% return on your cash in 10 days is often better than any investment you can make in the stock market.
So it's about being active, not passive. You're actively managing every dollar, treating it like an employee that needs to do work.
And using automation here as well. AP automation can pre-approve budgets and sync spend to your general ledger codes. It stops the bottleneck of invoices sitting on someone's desk for a week waiting for signature.
Which leads us perfectly into Section 4, expense control and the role of technology. The source mentions a line-by-line audit. Now, I hear that and I just want to take a nap. That sounds incredibly tedious.
It is tedious. I won't lie to you.
Yeah.
But that is why it is effective.
Yeah.
You need to look at the monthly outlays with a magnifying glass. The biggest culprit usually.
Let me guess. Subscriptions.
Subscriptions.
Oh, the subscription creep. I am guilty of this personally.
We all are. It's real. You signed up for a SaaS tool 3 years ago for a specific project.
All right.
The project finished 2 years ago, but you're still paying $50 a month because nobody bothered to cancel it.
It adds up.
It adds up. The advice is to cut low-value subscriptions ruthlessly and set spend rules. Discretionary buys should need pre-approval above a certain threshold.
Right. And another point was right-sizing inventory. We touched on this with the 3 buckets, but how does that fit into expense control?
Think of inventory as cash in a cardboard box. If it's sitting on a shelf gathering dust, your cash is trapped.
Right.
You can't use it to pay rent. You can't use it to hire. If it's not moving, it's dead weight.
I want to circle back to the tech piece. We talked about automation, but the phrase the source uses is same-hour liquidity visibility. That sounds like jargon. What does that mean practically for a business leader?
It means the end of the month-end close nightmare. In the old days, your finance team would spend the first 2 weeks of the month just data entering invoices to figure out how last month went.
Right.
With modern AP tools, invoices are captured, auto-coded to the right budget line, and drafted for payment instantly.
So the finance team isn't just typing numbers anymore.
No. It frees them up to focus on exceptions and strategy. It moves finance from scorekeeping, just telling you the score of the game that already finished, to game planning for the next quarter.
I love that shift. From scorekeeper to coach. Now, Section 5 addresses a topic that often carries a heavy stigma: borrowing, financing.
Yes.
Many people think debt is bad, full stop. But the source frames this as the safety net versus strategic tool.
We really need to break that stigma. Financing is a tool, like a hammer. You can build a house with it, or you can smash your thumb. It depends on how you use it.
Okay.
The source discusses two main types: the line of credit, LOC, and term loans. And they have very different uses.
Break it down for us. When do I use which?
You use a line of credit for short-term gaps. Think payroll smoothing or stocking up on seasonal inventory before the holiday rush. It's like a credit card. You draw on it, and you pay it off when the cash comes in.
And the term loan.
Term loans are for fixed assets, buying a big piece of machinery, a delivery vehicle, or a massive office build-out.
Okay.
The rule of thumb is match the payment to the asset's life. Don't use a short-term credit line to buy a machine that lasts 10 years. That's how you get into a cash crunch.
The source has a crucial insight here that I think is the most important takeaway for this entire section on financing. Secure the credit line before you need it.
This cannot be overstated. It is the umbrella principle.
The umbrella principle.
Buy the umbrella when the sun is shining.
Yeah.
Because when it starts raining, when your cash flow is tight and you are desperate, banks get scared.
They see you as a risk.
You look risky. You have zero negotiating power. If you walk into a bank when your cash flow is positive and say, I want a line of credit for security, they will roll out the red carpet.
That is human nature, isn't it? Everyone wants to lend you money when you don't need it.
Exactly. But you have to take advantage of that. Secure the line, pay the small fee to keep it open, and sleep better at night knowing it's there.
Right.
And just a quick note on covenants. The source mentions being aware of the reporting rules your lender requires. Keep that relationship predictable. Bankers hate surprises even more than business owners do.
So we've covered the fundamentals, the rituals, the inflows, outflows, expenses, and financing. We've built quite the roadmap here. As we move to the conclusion, I want to ask, what is the ultimate so what for the modern professional listening to this? Why does this matter beyond just survival?
It matters because cash flow management isn't just about survival. It is about resilience.
Yeah.
That is the word Römer uses.
Resilience.
When you have this handled, you convert volatility, which is inevitable in business, into predictable results.
And that changes how you operate in the market. You aren't constantly looking over your shoulder.
Completely. It lowers your cost of capital because lenders trust you. But more importantly, it empowers you to pivot.
Okay.
If a downturn hits, or if a competitor stumbles and you have a chance to grab market share, you can act. You don't have to pause strategic projects because you're waiting for an invoice to clear.
It's the difference between being a passenger in your business and being the driver.
And looking forward, the future of work belongs to businesses that use data, specifically forecasts, to predict tomorrow rather than just reporting on yesterday.
Right.
By automating the chore of cash flow, the AP, the AR, the data entry leaders can focus on the strategy of growth. That is where the competitive advantage lives.
That is a powerful place to land. It's not just accounting, it's the fuel for sustainable scaling.
Precisely.
Well, we have unpacked a lot today, from the 3 buckets of cash flow to the 13-week forecast, and why you should be asking for discounts and giving them when the math works.
And remembering that cash is the oxygen of the business. You can survive a long time without food profit, but you can't survive long without oxygen.
A vital reminder. Before you go, here's a thought to mull over. We talked a lot about using cash flow to survive and stabilize. But imagine if you mastered this so well that your cash flow became a product in itself.
Interesting.
What if your payment terms were so attractive that vendors preferred you over competitors, even at a lower price point? It's worth thinking about how financial efficiency can actually be a part of your brand value proposition.
That is a fascinating angle. Financial reliability as a competitive moat. I like that.
Thank you for tuning in to the SmartKeys podcast. We hope this deep dive helps you turn your financial data into a strategic weapon.
It's been a pleasure. Keep watching that runway.
If you enjoyed this episode and want more insights on the future of work and business trends, please hit that subscribe button. And definitely check out the show notes. We have the link there to read the full article, Cash Flow Management Strategies for Sustainable Scaling by Felix Römer. It's packed with even more details than we could cover here. Until next time, keep working smarter.